It's time for Stock Picks. Retailer Pick n Pay, importer and distributor of industrial, automotive and electrics products, Hudaco, and investment holding group Reinet are up for assessment. Keith McLachlan, CIO of Integral Asset Management, joins us with his analysis of these counters. Keith, thanks so much for your time this afternoon. So Pick n Pay has been one that's been on your radar for quite some time. The two-step recapitalization plan at the heart of the company's turnaround efforts. This included a rights offer, of course, and unbundling Boxer and listing it. Just your thoughts on the counter as we are in 2025 and we've seen those efforts kind of coming together at the end of last year.
Absolutely. As you touched on, the two-stage capitalization is in fact in the rearview mirror. It has happened. The rights issue was oversubscribed. The Boxer Pick n Pay effectively sold a third of their stake and listed it on the JSE to realize value. Their balance sheet at last moment was net cash. We will see when they report the next set of results what it looks like. But the kind of basic math is the balance sheet is not correct. The focus operations. The latest data point we have on that was they did do a sales and trading update, and we actually saw, if you strip out the Boxer numbers and you just look at Pick n Pay and you like for like on their South African domestic operations, and in fact you zoom even more closely into the last 19 weeks, i.e. post the recapitalization, post all of this, focusing on the turnaround, what we see is positive like-for-like sales growth despite having a store network where they cut 32 stores, which is roughly about 3% of their South African store base. I expect that to continue. The uptick in the like-for-like and positive like-for-like same-store sales growth is really, really good. Slightly better than I expected, to be honest. So we will see what the full year results look like, and we will see going forward. But the early stage of the turnaround, the numbers look good, the balance sheet is fixed, and I suppose the real work begins now, because you've got to get these stores operationally working, and then you've got to consider, in fact, the existential threat is, what do you offer consumers? Why do you get them through the door coming to your store?
And that brings me to my next question. I was about to ask you if you think we'll still see more pain down the line for Pick n Pay. You mentioned there, they're still closing some stores. They are net cash positive. But how confident are we that they won't make the same mistakes that they've made before? There's also really tough competition.
So that's an excellent question. I mean, the competition in the retail environment in South Africa has never been as tough as it is now. You've got a absolute Goliath that is Shoprite, and that is doing spectacularly well, that has gained massive amounts of market share. Dynamics have changed, where in fact there's online as well as in-store purchasing. So it's never been as complicated and it's never been as competitive as it is now to turn it around. But if you stand back, what you do have is you have probably about 80% of your store real estate is good. I mean, if we just work with Pareto principle, 20% of your stores is probably generating 80% of your losses. So if you can close those down, wind those out and the like, and in an environment where there's appetite, for example, from Shoprite to take over those leases, the landlords are probably going to be a lot kinder on you cancelling your leases and buying them out early. So you can get the center of the group possibly working. There is some underinvestment that you need to do. You need to play catch up perhaps on DCs or at least consolidation, and you need to play catch up on online. But what you do have is you have the center of your stores that are probably reasonable, and you have hopefully positive net cash flows, and you don't have a gun to your head on the balance sheet, which is debt. So what you do have is you have time that you didn't have if you roll back 12 months, 18 months to get this turnaround right. It is probably going to look a lot better in the earlier days when you're closing out the loss-making stores, because, like I said, a handful of stores can actually create quite a bit of loss in the center. You close those out. It looks like the company has moved forward, and then you have to start to do the hard yards of winning back the market share you've lost. And that's going to be a bit trickier, but we're probably about 18 months, 2 years away from that showing. The early numbers look good, but it is very, very early.
What I found really interesting with Pick n Pay is its online app, Pick n Pay ASAP. It's interesting to see how it functions so much better within the Mr. Delivery app, whereas there are so much problems with the standalone app. And I'd just like to get your analysis on how it fares up against a Checkers 6060. I mean, they're available on two separate apps, and here Checkers 6060 is still kind of gaining more market share in that realm of the retail sector.
So that's a great question, but let's stand back and look at Checkers 6060 app and consider it in the global context. And I don't think South Africans appreciate quite how well run Shoprite is.
Yeah.
Walmart in America, Costco, like these global retailers cannot get 1 hour delivery right. Shoprite is the only retailer in the world that I'm aware of that has gotten this working, rolled it out nationally, and it's operating smoothly. So Shoprite has a real powerful advantage there, and they're winning. And it has certainly won their market share and fed like-for-like volume through their stores. So I would actually to compare Pick n Pay's WhatsApp ASAP at least to Checkers 6060 is just a completely unfair comparison. You almost got to compare it to other things because nothing in the world can compare to. Absolutely. But that said, I don't think Pick n Pay has to solve the online to get their business working. They just need to actually get the basics in place. Get your price points right, get your products right, get your service at the store level right, get your footprint right. Get the fresh side right, get the prepared side right. Like that, I don't think it is a fair comparison to compare them and to even consider them competing with Checkers 6060. I think their focus should be more on the store and less on online.
All right, let's move over to your next stock, Hudaco, the auto and electronics manufacturer, which has had a tough time during its annual period, recording declines in both its top and bottom line. But the group seems to be optimistic about its prospects. Is this one that that relies on real economic growth for us to see that being translated into its balance sheet?
So at a macro level, yes. I mean, as a consumer products and engineering suppliers, they're buying in lots of products, they're moving them into industries and shops and businesses and the like that ultimately consume them. You need economic growth. But Hudaco does have a couple of things playing in its favor that aren't necessarily obvious. The first one is that there's a generation of really nice little industrial businesses, really nice products businesses around South Africa. They were built that are in nice niches that the generation that built them is retiring. The generation that should be taking over from them has probably either left the country, living in London or New York, and or doesn't want to run an industrial business, wants to work in an office in Sandton. So there is a unique level of businesses that are up for sale that are actually really, really good businesses. And at the same time that the private equity market in South Africa is just completely hollowed out. There's almost no one operating. So a natural fit to plug these businesses in, run them well, and push them through their chain and route to market is Hudaco. And you can see, I mean, the last year or so, they've done 3 good acquisitions. You touched on the fact that revenue is down and profits are down, but you need to look at the cadence throughout the year. Because remember, this was over an election year and a particularly contested election year. And in fact, in the first half, HEPS was down 15%. For a full year, it was only down 6%. They gained in the second half. And in fact, if you look at the period, the 5 months following the formation of the GNU, they in fact grew over that period. So when you talk to the management, these results don't look great at face value. But you talk to management and they actually have some quiet optimism about the year going ahead.
Lastly, just before I let you go, let's touch on Reinet. A lot of corporate action taking place on that front. Most significant is that it exited its position in British American Tobacco. So it's sitting on a lot of cash on hand. Just your thoughts around Reinet and whether you expect to see any deals on that front anytime soon.
So, to be blunt, absolutely. This is an investment holding company. Its ammo is cash.
Yeah.
It's always said its internal benchmarks that if it can find investments that are better than its expected total return on British American Tobacco, it will sell British American Tobacco and buy those investments. That's its internal rate of internal hurdle rate for new investments. So I would absolutely expect this capital to be applied to one or more investments.
Yeah.
It is just interesting, one, to consider from an outside investor's perspective how much you're paying for it, and two, where we are in the cycle. And you're currently paying slightly less than a 40% discount to its net asset value, which includes, as you said, about a third, call it a fifth, a quarter of its NAV being straight in cash.
Yeah.
Its long-term running average is about that, but where we are in the cycles, we find ourselves with particularly expensive offshore markets, particularly expensive American markets, growing geopolitical risk, all sorts of things happening. If we just look at Berkshire Hathaway, they're sitting on a record cash pile now in the cycle. Same with Reinet. This is a fantastic time in the cycle to have a large amount of ammo on your balance sheet that you can spend in certain, potentially as valuations become a lot cheaper at any kind of stress point in the market. We will see what they spend it on, but Reinet's looking particularly interesting and very, very defensive.
Keith, thanks so much for your time and just taking us through that analysis. That was Keith McLachlan, CIO of Integral Asset Management.